All right. Hi, everybody. My name is Matt Bellotti. I'm a product lead here at AngelList. For anyone unfamiliar with AngelList, we focus on building modern software and pairing that with premium services to help firms ranging from emerging managers to established firms launch new investment vehicles or streamline existing fund operations. Before I introduce our guests, I want to go over two quick housekeeping items. First, our speakers have graciously offered their time to participate in some live Q&A toward the end of the conversation. So we encourage you to submit your questions as the conversation goes on. So don't feel like you have to wait till the end to ask your Q&A questions. You can put them in the Q&A chat there. And then as there's time at the end, we'll get through as many of those as we can. And second, this conversation is being recorded, so we will be sure to share the link and recording with all of you via email following the call. All right, with that, let's move on to our guest speakers. I'm really excited today to be joined by Dolph Hellman and Ken Rasamny from Orrick. Thank you both so much for joining. I think they're getting pushed up to the stage now. Yeah, here we go. There they are. Hey,
Perfect.
Dolph, how's it going?
Great, great. How are you, Matt?
Good, good. Hey, Ken.
Hey Matt, how are you?
Good. Thanks for joining today. And before I let these two guys introduce themselves, a bit more about Orrick. So, Orrick is a leading global law firm with one of the most recognized fund formation practices in the world. Their team works with venture capital, private equity, hedge fund managers, and others at every stage, from first-time funds to multi-billion-dollar vehicles, helping them navigate the complexities of structuring, launching, and scaling their funds and firms. They're known for their deep expertise with institutional investors and their track record in the startup economy. Orrick has become a trusted legal partner for managers who want to build durable funds and confidence. That is it for my intro on Orrick. Why don't we have each of you guys introduce yourselves? Dolph, will have you start, and then we'll go with Ken.
Great, great. Thanks, Matt. So yeah, I'm a partner at Orrick in the San Francisco office, and I specialize in fund formation, primarily VC fund formation, just because I'm on the West Coast, and that tends to be the asset class that I see the most. But we also represent, and I have represented a bunch of institutional investors over the years in connection with their alternative investments program. So I think one thing that I like to tout about myself is I think I have a pretty good sense of what's market because I see deals on both sides of the table representing institutional investors when they're deploying capital and obviously representing sponsors while they're raising capital. So it's a pleasure to be here and I look forward to the conversation. I'll turn it over to Ken for a minute to introduce himself.
Great, thanks so much, Dolph. And yeah, just excellent to be on the webinar here, connecting with everyone. So my name is Ken Rasamny. I'm a fund formation specialist located in Southern California. I've been in this industry for almost 20 years now and really love it. Work with a range of fund sponsors from VC to private equity to also hedge fund managers. And similar to Dolph, I'll also represent some institutional LPs that are allocating across a range of strategies, which is great to be, on both sides just to see where markets are shifting.
All right. Thank you both. It's good to have you here. So let's go ahead and jump right into the conversation. So I want to start with setting the stage here for the conversation, which is like why choosing a law firm is critical and choosing the right one is critical. So when a manager decides to launch a fund, one of the first big decisions is obviously like which legal partner to bring in. It's a choice that can shape the entire fundraising process. So, Ken, would love to hear from you. Why does the choice of a law firm matter so much when a fund manager is starting a new fund? And at what in the process should they bring in legal counsel?
Yeah, I mean, so choosing the right legal counsel really does form the foundation for a successful fundraise, as well as successful deployment of capital. And the earlier, the better. So really, before you start marketing to potential LPs, you want to get the right law firm to partner with. It really is a specialized and a niche industry where you need someone who has years of experience to in order to avoid common pitfalls and really just set you up, for success, whether that's tax structuring, whether it's making sure you're prepared internally for, LP due diligence that will come up, as well as just reviewing your documents, your marketing documents that are ultimately going to be reviewed by LPs.
And I'll just chime in there for a second. I think also the asset class, having expertise in the asset class is important. PE funds tend to be much more structured in terms of tax efficiency for investors, and they tend to be more kind of more complex in some respects. So if you hire a PE lawyer, who funds lawyer, to do your fund formation work, he or she may not be the right person to do the project, just because the VC fund landscape is a little bit different. And obviously cost can be a little bit different. So yeah, I think choosing the right law firm is obviously very important. The other thing is that you have to keep in mind that a fund interest is a security. And so before you're marketing the security, you want to make sure you're complying with all the SEC requirements related to that. So it's important to have counsel guide you through that process, because it's a little bit confusing kind of what would constitute a general solicitation, what doesn't.
Yeah.
Yeah, and it can also lend credibility to certain investors that are used to seeing certain law firm names, right, that are representing a given fund manager. So that's it's a nice signal to the market. And back to Dolph's point in terms of this being an offering of securities, right, that makes it extremely kind of specialized, where you need someone with the right experience. You also need someone who knows how to, hopefully avoid having to register with the SEC. Sometimes you can't avoid it, but working with Orrick, we are really well versed with, the different ways to avoid SEC registration, which is pretty common, right, among VC and private equity fund managers.
Awesome. Yeah. Very important to get all that stuff right. Do not want to mess it up. Um, so I want to talk a little bit about like the actual relationship between like the fund and the law firm. So a lot of managers know that they need a law firm, right? Like they need to work through like, securities laws and et cetera. But don't really know necessarily what that relationship might look like in practice, or like what a good relationship looks like in practice. Could we talk a little bit about like what are some of the more misunderstood parts of like what the law firms actually do for the fund managers and how they generally would work together?
Sure, I
Yeah.
can take
So
that. Oh, sorry, Ken, go ahead.
yeah, sure. Yeah. I mean, so, it's not that we're just simply drafters, right? Like we really are providing strategic guidance. And in a typical fund launch that, Orc will be working on, we tend to just break this up into two different phases, right? So the first phase being really a true marketing phase, where you don't need to have, all of your fund documents ready to go A through Z, right? And instead, we really focus on what you really need to go to market, right? Especially as investors are reviewing your marketing materials, right? Things may change in terms of what you're actually going to end up proposing for the investment term. So we'll really focus on reviewing your deck, and we see a lot of these. So just making sure that it not only has the right disclaimers, but that it is sending the right signals to the market, as well as just preparing your term sheet, really, that's going to summarize not only the economics, right, your management fee and carry, but also certain LP remedies that you're giving to folks. And as Dolph mentioned, because we also represent LPs, we have a really good sense of what's middle of the road, so that will kind of increase the speed that you can actually set up your fund, because you're hopefully doing less negotiation with investors.
Yeah, to echo what Ken said, the pitch deck's really important, not only from an offering perspective. You want to make sure it's compliant with US security laws, but also from a storytelling perspective. So we like to look at it, at least when I look at pitch decks, I like to think in terms of, if I were an investor, would this be compelling to me? And giving guidance to clients in that regard, I think, is important. Again, because as Ken mentioned, we see lots of pitch decks, lots of folks that are trying to raise capital, and being able to stand out in the market is pretty important. So obviously, we provide the legal advice when it comes to what you can and can't say on your pitch deck, but we also try to provide kind of market guidance as well.
Yeah, and I think, one key in your deck, right, is really just to demonstrate how you're a differentiator with sourcing and picking and winning, right, on deals. And, there's just so much competition out there, right? So how do you really kind of tell that story? And so because we've done this so many times with different emerging managers, right, we can give you some good strategic insight. One example would be, we see some emerging managers having success with starting with single asset SPVs within a given vertical, or perhaps more than one vertical, where they really ultimately, right, they want to raise a commingled fund that is in that space, right? So it can be helpful, especially from a fundraising perspective, just to be able to get certain allocations within that vertical or within that strategy, and then this way you can develop a track record that's concentrated there, and that can help propel you into raising, an actual commingled fund, right? Where folks are giving you a commitment without necessarily knowing the exact portcos that you're going to be deploying into.
Yeah, I love this. It's really a good law firm partner is not just like, hey, get us this paperwork, but it's let's actually partner. Like let's like you're part of the team and helping us make this entire process successful. Um, on this note, is there like a too early to bring in a law or is it like still worth at least having the conversation early? Dolph, I don't know if you want to take that one.
Yeah, no, I think it's worth having a conversation. I mean, as Ken mentioned, we work with a ton of emerging managers, some that are more ready to go to market and some that are less ready to go to market. And I think just helping our clients, our potential clients, kind of understand how the game works, so to speak, in terms of, what LPs are looking for in terms of the economics that the fund presents, as well as the legal remedies that the fund presents. And being able to have that conversation earlier rather than later, I think is a good idea. I mean, the one thing that people I think underestimate is just how difficult it is to raise capital. And so, like as Ken mentioned, having a track record, even if it's just one or two SPVs, is sometimes a good way to go. You can also sometimes do what's referred to as warehouse those investments. So you make them and then you roll them into the fund. And then that way it's less of a blind pool, at least initially for the investors as it relates to your initial investments, because they're already in the fund and people that kind of understand what sort of access you can get to companies that the fund will want to invest in. It kind of takes away some of the uncertainty, I think, that fund managers have to explain when they're trying to raise capital.
Yeah, and another benefit to reaching out to, law firm early, right? I really don't think it's too early, honestly. And is that we can help set you up with other service providers that you're really going to need, right? So, for instance, you're going to need, a fund administrator, right? And so we routinely are working with AngelList, right? And we've got a lot of clients together where we find, successful, we're successful synergies. But in addition to, a fund administrator to kind of help with investor reporting and LP onboarding, you also need a bank, right? You're going to need a bank account for your fund, and that can, sometimes it can take some time. So you don't want that to delay anything. You're also going to need someone to help with tax preparation, right? So if your typical VC or private equity fund, right, will be a pass-through entity. So it'll be treated as a partnership for tax purposes. So you're going to need K1s to go to all your investors. And so you'll need a firm to help you do that. So we've got, great relationships that we can introduce our clients with, or even potential clients with, just so you get that lined up.
All right, I want to follow this thread and talk a little bit. So we spoke a bunch about like a fun like choosing the law firm, what the partnership looks like. Let's talk about all right, well, we're now working with like a fund is now working with the law firm. What are some of the more common mistakes that you see fund managers make? Right. We talked a little bit just now about like maybe not understanding the timelines of, opening a bank account and like things along that sense. Maybe aside from timelines, and Dolph, I'll ask this to you to start us. What are some of the other like common pitfalls you see?
Yeah, so one pitfall I see is that sometimes fund managers or emerging managers become a little bit desperate, so to speak, and will kind of give away the farm when it comes to either economics for an anchor investor or if they need an anchor investor, kind of giving away the farm for the next two or three funds, because usually the way the seeding works is that if you have an anchor come in, they usually want a stake of the GP and they usually want a stake of the GP and not just the first fund, but in subsequent funds. So we have a few examples of clients we've worked with recently that have kind of been tied down to those sort of relationships, which, obviously you have to weigh the cost benefits of entering into that type of relationship. But, and sometimes it makes sense. I'm not saying that it doesn't, but you have to think hard and long about what you're giving away or what you're agreeing to, because it's going to live with you for a while. So that's, I would say, one common mistake. And then, as I mentioned, just kind of understanding how long it takes to go from meeting a potential investor to actually closing on an investment. I mean, it usually takes 3 or 4 meetings. They want to kind of get to know you, understand you, because they're not investing in the name of the fund. They're investing in you as an individual. So they need to have comfort that you're the type of person that they can trust and that they believe is going to be successful. So it takes time, a lot of time.
And to follow that thread on time, I think especially first time managers can be in a place where like they're very ambitious, right? And they should be really excited about their ability to raise and run a fund. But let's say a manager comes to you saying like, "Hey, we want to raise $100 million and launch within a month." Like, how do you work to sort of like set the right expectations and make sure that like everyone's going to have a good experience going forward?
Yeah, I mean, from the documentation perspective, at least we can pull stuff together within a month, right? So, but explaining to the potential client that, it's not as simple as he or she might believe, or if they're a team, they might believe. So that's why we try to like bifurcate the work, as Ken mentioned. So we try to put together the summary of key terms so that there's a clear understanding of what the LPA terms are going to be looking like once the fund does close, and then working with the client on the pitch deck, and then making sure that they actually have soft commitments circled, so to speak. And sometimes we'll put together a commitment letter. It's usually not binding because the last thing you want to do as a fund manager is sue a potential investor for not investing in your fund. Just kind of would put a black mark on you going forward. But there is some psychological benefit to having a term sheet that an investor signs, basically that says, if you are able to raise this amount of capital by the such and such date, and the terms are set forth in the attached term sheet, I agree that I'll commit, X amount of dollars to the fund. Having that sort of certainty and kind of cobbling together the commitments from here and there, herding cats, so to speak, I think is something that I would want to explain and make sure the client understands. Again, going back to the timing phrase. I mean, throwing out numbers. One thing about numbers is there has to be kind of a business reason why you're raising that much capital, especially if it's an early stage VC fund. I mean, $100 million is a lot of checks to write. And so if you're an investor, you're going to be thinking about, is this person or is this individual or these teams of individuals, are they going to be able to deploy the capital in a sensible manner, right? And they're going to be able to monitor the investments that they make. So kind of sometimes you're better off, raising a smaller amount of capital initially, getting your track record in place, and then going out for larger commitments. 100 million out of the gate, unless you've got relationships and a track record, I think is really difficult to achieve. I don't know, Ken,
And
do
I
you have
and
any?
I
Yeah.
yeah, and I'd say it's better to be conservative in terms of your target, right? And so typically, right, like you would list what your target raise is in your deck or in your term sheet, right? So it's better to be conservative, and then if you do find a nice anchor up front that you feel will help you build momentum as you kind of syndicate out with other investors writing smaller checks, and you feel that really you can go with a slightly larger figure, then we have plenty of clients that do that. I think that's the preferable alternative than going out too big and then it's signaling that you had like an unsuccessful raise. I also think it's important to note that like there's just different you know ways to go about raising a fund in terms of like who you focus on first. Like yes, ideally you probably get your anchor lined up first, right? But sometimes that doesn't happen until towards the end of your fundraise, which we see is typically 12 months, but more recently it's been as long as 18 months. So I have plenty of clients that do get their anchor right like towards the end of the fundraise, and they kind of syndicate out with smaller LPs up front, which is fine, right? But I think the key, as Dolph mentioned, is you don't want to get to an initial closing too early, right? Like you do at least want like about a third, right, of your target lined up so that you can at least still successfully deploy your strategy if you don't fully kind of get the fund subscribed.
Yeah, that's a question I often ask, potential clients is, what's the minimum amount you need to raise in order to be able to execute on your business plan? Because that's going to be asked by investors as well. And if you come short of that, then if you're not going to be able to be diversified enough that will benefit the investors, it's really difficult to get folks to sign up.
Yeah. All right, so let's follow this track and fast forward in the life cycle here and say the fundraising is underway. There's different sets of challenges as they're going through the fundraising process. Ken, maybe let's kick it off with you here. Once a fund is launched, like where do managers lean most on their law firm from that point forward? Or I guess once they're like actively raising.
Yeah, so it's key to realize that once you have your initial closing, right, at that point now the time is basically your fundraise period is ticking. So you've got 12 to 18 months to raise, but you can still deploy capital, right? And so the way this typically works, and we get a lot of questions on this, is how to how to equalize all LPs, right? And deal with the fact that just because an LP is investing after a given investment is made doesn't mean that they're not getting exposure to that investment. They are. They essentially need to buy in. So we get a lot of questions on that and what that looks like. And so we can help work with the administrator to get that lined up properly. We also get rolling side letters coming in, right? And sometimes folks are asking for like an MFN, a most favored nations provision. So we need to make sure that all the side letters are basically lined up properly to the extent we're dealing with an MFN. Let's see. Sometimes we also get, as part of a LP due diligence, if you have, for instance, an anchor LP coming in, like let's say 10 months into the fundraise, if they ask for a given change in the document and it's commercially reasonable, right? Maybe more so on the LP favorable end of the spectrum, but we're willing to kind of give on that, then sure. And some changes may require consent, but if it is LP favorable, typically no consent's required, but you still do need to properly paper it and circulate that to all LPs. So that's another way we get involved.
Yeah, I think the side letter point is sometimes not quite completely understood by the client. I mean, the side letters are there to address kind of specific needs or concerns that a particular investor has. And sometimes it's appropriate to put certain provisions in side letters. Sometimes it's more appropriate to put provisions into the LPA. One thing we do kind of stress is that when your first closed LPA presumably is going to be the template that you use for your second fund and your third fund, et cetera. So once you've kind of put something in an LPA, it's kind of hard to take it out, particularly if it's beneficial for the LPs. So sometimes we do, to the extent we can, we try to push stuff to side letters because you never know if that particular investor is going to be in fund two. And that way you don't have to explain to investors, well, this was an agreement I made with such and such investor in fund one. That investor is not participating in fund two, so we thought it was appropriate to take that out. If it's a provision that's beneficial for the LPs, that's going to be very difficult to do. So having good advice in terms of how you navigate the side letter process, I think is really important.
And another point is we think it's advantageous to use the same law firm to serve as deal counsel in terms of your deployment of capital into portfolio companies, in particular where you may have co-investments, right? So you can imagine a situation where the fund gets an allocation to some portfolio company, but perhaps for risk diversification, right? Like you don't want to take the entire allocation by the fund. So you've got some excess, right, in that deal. In that situation, right, you could go to your LPs or perhaps like your three biggest LPs and just say, hey, look, we've got this kind of excess for this deal. Would you be interested? And if so, then we'll create basically a separate, vehicle for you to invest in alongside the fund. So that can be really helpful if you have the same law firm, working on the actual investment and also setting up that SPV. So that's another way that, we would be involved after, post-launch.
All right, so we talked about some side letters, LPA changes, co-investment stuff. I guess to sort of tie up this part of the discussion here, when we think about a fund like nearing the final parts of the fundraising process or executing on the deployment process, are there any other things that you see where fund managers stumble and either create a situation for themselves that will make the rest of that deployment complicated or like waterfall into other problems with future fundraises?
I think agreeing, as I mentioned earlier, kind of agreeing to terms that may not be most beneficial to the GP can be kind of difficult to navigate down the road. So sometimes we'll have clients come to us and say, I've agreed to X, Y, Z, and they hadn't really consulted with us beforehand, and kind of not understanding the implications of that going forward, I think can be kind of a pitfall or a trap that some fund managers fall into.
I think, it's pretty common to see structuring on the carried interest being charged, so that, if you have a solo GP even, right, it's still pretty common to have a sharing arrangement with that carry for certain folks that are, sourcing deals for you on a one-off basis as venture partners, right, or as advisors. So it can be helpful to get that lined up ahead of time to make sure that from a tax perspective, right, that recipient's share of the carry is on a flow through tax basis is advantageous, so that they're getting a long-term capital gains treatment as opposed to current income. So that's one pitfall, is just being caught flat-footed on that. You need to have like certain tax provisions in the GP's operating agreement, right? So that's, working with us, right? We would give you a heads up on that to make sure that's already lined up, so that it doesn't slow any kind of given deal down, right?
All right, let's talk a bit about institutional investors. So, we've touched on this a little bit with like, handling side letters and whatnot. I'd love to hear from you. Like, how do you help the managers navigate the demands and processes of institutional investors, whether it's like additional diligence or them like pushing for specific provisions? Like, are you going through the GP? Are you helping like talk to the institutional investors? Like, I guess like how do you help fund, managers navigate that? And Dolph, I don't know if you want to kick us
Yeah,
off on
no,
that.
that's a great question. So a couple things. One is, I'll just say this, some institutional investors, particularly governmental pension plans, have what's referred to as emerging manager programs. Now, the name sounds great, I'm a first-time fund, I must be an emerging manager, but it doesn't work that way. It's usually like you have to have had 3 or 4 funds under your belt to actually be an emerging manager. So you can have meetings and submit materials to the gatekeepers. Those are the folks that the governmental pension plans or other institutional investors hire to kind of vet different fund opportunities. You can kind of start that process whenever you want to, and they're usually pretty good about taking meetings. But understand that it's going to be a while before, if you're a first-time fund manager, it's going to be a long road before you actually get to certain institutional investors. So I think that's important to know. Then understanding the gatekeeper process, the fact that these institutional investors do hire third-party advisors that do diligence on you, is really important to keep in mind. That's why we try to go out with a set of documents that, at least even initially for your first fund, is one that is close enough that an institutional investor would be willing to invest in it. So we want to make sure there are robust LP remedies, for example, that there's robust indemnification provisions, that the distribution waterfall makes sense, et cetera. So kind of setting you up to succeed, to be able to raise capital from an institutional investor from fund one, I think is important. Again, as I mentioned earlier, because of the fact that whatever you put in fund one and that LPA is going to live with you for a long time. And then just understanding the PPM process, the private placement memorandum process. So that's both a marketing document as well as a secure disclosure document. And some institutional investors just out of the gate require that there be PPM, or confidential information memorandum. So kind of understanding what that is and how that is going to change the fundraising process and how expensive it can be to prepare, I think is important to understand. I mean, our kind of rough rule of thumb is that if you're not targeting institutional investors and your fund is at least under 100 million in terms of size, that you usually don't need a PPM. But sometimes, you'll need one. And so what we'll end up doing is taking your pitch deck and the risk factors and the security law disclosures that would normally we would put in the subscription agreement. We put that into a PPM, and we can put one together, fairly quickly. But just understanding kind of some institutional investors do require certain documents. It's more like a hygiene sort of thing, to making sure that you're reputable. And that kind of goes back to the law firm you choose as well. They wanted to understand that the law firm is actually putting together representations and warranties in those documents that are applicable and that you can live with.
Yeah, and I'd say institutional LPs really focus on alignment of interests, right, between LPs and the GP. So, for instance, they're going to just be ready for the questions, right, that are going to come from them in relation to like how much capital you're putting in. Like, they want to make sure you have some skin in the game. It doesn't mean that you can't use management fee waivers towards, like, as a credit, right, towards the GP, contribution, right, a cashless contribution. It doesn't mean you can't do that, but just be ready for the question as to like, why are you doing this, right? You can explain, look, like, I'm early in my career, right? Like, this is my first fund. It's, I just don't really have, $1 million in cash, right, ready to go into the fund, or even 100,000, right? And just so be ready to explain that. Another question you'll probably get is time commitment, right? So it's okay if you're doing other things, right? And regardless of how, like, your law firm will set up the key person provision that basically says that you're going to dedicate majority of your business time or sufficient amount of your business time to the fund, or else, the investment period shuts down. Like, regardless of that, you're going to get questions from LPs about like other stuff that you're doing, which again, it's pretty common, right? At least in VC. But just be ready to kind of answer that in a crisp fashion, and about how you really are dedicated to this fund. You understand that it's, a 10 to 15-year commitment, right? But just be ready to kind of navigate that conversation, as well as any conflicts that might come up from whatever it else is that you're doing.
Yeah, in addition to GP commitments, right, there's also the management fee issue. And so sometimes, if the rule of thumb is, 2 and 20, 2% management fee per annum, 20% carry. But sometimes that doesn't make sense for an emerging manager, because they may not have the capital to kind of run their operations based upon, if it's a $25 million fund, 2% of that per year is not a whole lot of money to run a fund, right? So having a budget-based management fee and an explanation as to why you need a certain amount of capital and need to front load it is also important. And sometimes institutional investors, I mean, they'll be receptive to it as long as there's a business need for it. So being able to explain that as part of the process in meeting with institutional investors, I think, is important.
All right, I've got questions on this topic, and then we'll go to Q&A. So if anyone listening does have any other Q&A questions, feel free to pop them in the chat. So sometimes some of these institutional investors, like pension funds, for example, might have like very specific requirements or special processes that they always run. How do you approach situations, where there are these institutional investors that are going to have like, this is how they run it, and they're like, they run it this way, and you're going to have to go through this and all that? Like, how do you help fund managers deal with that?
I
Yeah, I'll
think,
take that.
it's
Oh, sorry.
no, I think it's key. I mean, look, like, if this is your anchor LP, basically, my view is, you really need to pay very close attention to what they're asking, right? And it's likely that they've been able to get whatever deal is that they're asking, they've been able to get it with other managers. It doesn't mean you need to blindly say yes, you want to go into it eyes wide open, but um, I would, do everything you can to be flexible in terms of accommodating that, as long as you're comfortable with that arrangement for the next fund, right? As Dolph kind of mentioned, because once you get something in writing, whether it's through a side letter or it's through the LPA, right, it's very difficult to take out.
Yeah, there's always a battle of the forms. I mean, the GP wants to have consistency in the side letter terms that it agrees to with its investors. And likewise, an institutional investor in particular wants to have consistency with respect to the side letter provisions that it has, not only in your fund, but all the funds that it's invested in. So being able to kind of navigate that and work through those sort of issues, I think, is something that is a little bit tricky to do, right? So you want to do it diplomatically. You want to make sure you don't blow the investment, but at the same time, you want to make sure that whatever you're agreeing to is something that you're comfortable with going forward for a long time.
All right, I've got one more question here. So, Dolph, if you want to kick this one off. So
Sure.
for many managers, and I know some of the audience here is like first time fund managers, emerging managers, may not have really interfaced much with institutional investors. And those first institutional investor meetings like can be kind of a make or break moment, or at least very much feel like that for these fund managers. What's one of the most important pieces of advice that you'd give one of these managers preparing for one of those like first institutional investor conversations?
Just be yourself. I mean, be honest with them. You expect questions that are going to kind of push you in terms of what your experience is, what your track record is. Don't try to oversell yourself. I mean, I think that's a mistake that people make often, not only in fund formation or in pitching, trying to form a fund, but kind of in life generally. So just kind of being yourself, understanding that, it's a relationship that you're going to be building, and that, you need to make sure they need to be comfortable with you as a person just as much as they're comfortable with you as an investor. So that's why I think it's important to kind of be yourself, and don't, like I said, don't try to oversell yourself.
And then I would really just, again, try to focus on how you are differentiating yourself, right? With sourcing, picking, and winning, and also your track record, right? And it's okay if, I mean, look, ideally you do have some distributions and some DPI, but if you don't, like, that's okay. Like, especially if you're early in your career, you're certainly not alone, right? In terms of liquidity being tough to find these days in venture, with M&A and IPO markets not being where they should be. I mean, M&A picking up, right? But certainly with capital markets, still needs some movement there. So that's okay. But I would just focus on your TVPI in terms of, certain portcos you've invested in having up rounds, right? And just kind of highlighting those and understanding, right, that especially in venture, it's really all about the power law. So trying to focus on that and what you expect in the future, right? But just being honest with your track record and just kind of having crisp answers to those questions that will probably come from LPs in terms of your track record.
And one additional point on track record, if you're leaving another fund, attribution and being clear on how the track record is being divided up among you and your prior employer is super important. So you want to make, and sometimes, obviously it's a very important asset, right, to have the track record of a fund. And so sometimes your former employer doesn't want to give up the track record that you've developed. So even in those situations, even though they may not provide you with the carte blanche ability to do attribution for you or the investments you made at your prior fund, if you're the one sitting on the board, if you're the one speaking with the CFO and CEO, you can certainly use them as references instead. That's one way to kind of navigate around the track record issue. That can be a little thorny and something you want to talk with your legal counsel with sooner rather than later, because that can really derail a fundraising process if you're trying to claim an investment is yours and your former employer is saying, no, 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 wait a second, that's ours. That can lead to some pretty dicey situations.
All right. Thanks so much, guys. We're gonna jump to Q&A. We got some great questions that came in. We got two questions that were pretty similar, so I'll start with this one. What are some of the differences that a fund manager should plan for when bringing on a new legal firm for their first fund versus a second fund? And like, what are the differences there, and how should someone think about that? Maybe Ken, if you want to kick us off on that.
Yeah, so I'd say we pretty routinely will step in as fund counsel, for someone who either hasn't raised fund two, but would like to now, or maybe they even started it and then they realize they really need to kind of change to a more specialized firm. And there, I'd say we can take a flexible approach. It really kind of depends on the extent to which your fund one LPs are reallocating to fund two, and if they care or not if you switch documents, right? So if we look at the fund one documents and they're generally in good shape, and your anchor in fund one is also re-underwriting, right, for fund two, there probably makes sense to stick with the fund one documents, and we would review them, of course, and make certain updates as needed, trying to limit those updates since that would show up pretty clearly in the red line and might invite questions, right? Things like that. But generally, if they're LP favorable and important to make them, we would hope to make them. I'd say on the other hand, if the fund one documents really are not in good shape and you have most of your LPs don't like they're okay with a new set of documents and you don't really have that key anchor that feels strongly about sticking with the documents, then we can go with our form documents, right? So I'd say we take a flexible approach there.
Yeah, we definitely do. And sometimes it depends on like who the type of investors you're going to have in your fund. So high net worth individuals, I don't want to overgeneralize, but you tend to get less negotiation, frankly, with those sorts of investors, just because it's more of a relationship for them. And if they value you as a person and as an investor, they want to know what the fund documents say, but they're not going to be nitpicking on little provisions here and there. So I think understanding who the recipients of your documents are going to be is important. But yeah, the first question somebody's going to ask on a fund two is, can I see a red line against fund one? And to understand what the changes are and make sure that they're not in a worse position than when they were under fund one, which is why it's really important to make sure your fund one documents are something that you can live with going forward through fund two, fund three, fund four, et cetera.
Okay, this next question here. Let's say someone is raising their funds, they get to initial close, and they're very unhappy with their current law firm that they've been working with. Like, how complicated or difficult would it be to switch law firms, like during a fundraise? Like, is that a good time? Should they just kind of like deal with it until they get to the next fund? What should they do from there? Dolph, if you want to kick us off.
Yeah, so I mean, I personally think it's not a good message to send to the market that you're switching counsel in the middle of your fundraising. So, I mean, if somebody comes to us and says they're not happy with their current counsel, I would probably counsel them to stay with them at least through the end of the fundraising period, just because it does get complex. And it's going to add costs, right? And sometimes there are caps on org expenses and fund documents So you want to make sure you stay within that cap. Otherwise, it's coming out of your pocket in terms of, your management fee or your own pocket if the management fees aren't sufficient to cover the expensive override. So that's my personal opinion. It kind of depends on the facts and circumstances, I suppose. But at least out of the gate, that would be how I approach it.
Okay. This next question here, we have someone just asked a second version of a similar question. So, what are some terms, and Ken, we'll have you kick this one off. What are some terms specifically that GPs agree to that they later regret or like didn't really see the implications of initially? And maybe this could also be framed as like, what are the biggest mistakes that GP makes in those Fund One docs?
Yeah, I mean, well, one key one is, and this isn't always applicable, right? But for those folks that do have an anchor, just being really intentional in terms of what you're agreeing to with that anchor on a future basis. So, like, what deal are you agreeing to that might have implications for Fund Two and Fund Three? Are you promising them basically like sharing like economic rights to the carry and management fee for like the next two funds? Like some anchor LPs are really aggressive like that, right? Um, I'd say another one is going to be like when you can set up your successor fund, right? So there's a range of what we see, but essentially some LPs are pretty aggressive in not wanting you to set up your second fund until, let's say, you're 75 or 80% deployed for fund one, not including reserves, right? So if you're reserving quite a bit of capital, right, which some folks are doing, some folks are not reserving anything. Others are reserving like upwards of like 40 to 50% of the commitments for follow-ons, right? So imagine if you have that situation, it can take you a long time to get 75, 80% deployed, right? So on the flip end of that spectrum is, basically putting in your documents that you can start raising fund two once you're, 60% deployed, 50% deployed, including reserves, right? It's a lot easier to get to fund two. So that's one example right there.
Yeah, I have a few more. One would be partnering with somebody that you don't have a long-term relationship with, that you haven't worked with before. That because you have to think of the GP when it's multiple GPs as being almost like a marriage, that you're going to be with this person for at least 7, 8, 10 years, maybe perhaps if things go well, obviously longer than that. So making sure that you can work with the person. I've represented a number of funds where they've had to have a divorce, so to speak. And that goes back to the allocation of the track record and, who can fundraise where and which LPs are whose LPs, that sort of thing. So it can be really messy. So kind of making sure you're comfortable with the person you're partnering with, I think is really important. And then also just understanding, how you allocate your carry to either venture partners or advisors or others that are helping you. Sometimes I see way too much carry being allocated to third parties that may or may not, and the vesting of that carry too is really important. So kind of understanding how your economics are going to work going forward if you end up bringing in a venture partner or an advisor and giving them a certain percent of the carry and having it fully vested in a particular period of time. That's important, I think. And then the last one is just the management fee piece. I mean, because as Ken said, the investor is going to look to you to spend a substantial amount of your business time to the affairs of the partnership. And if you are doing that, you can't really have a side gig, right? So you need to make sure whatever the management fees are sufficient to pay yourself the salary that you deserve, as well as any team members that you bring in. And kind of underestimating that, I've seen that a lot where there's just not enough capital to kind of to go around to keep people engaged and be able to pay them to stay with the fund. So understanding kind of how the management fees budgeted, I think is really important.
And on that point, we do see some fund managers front loading management fees. So
Yeah.
you would start with a higher rate than 2%, and then basically have it reduced over the life of the fund. But at least this way upfront, they can really help with, launching your business.
And typically, not always, but typically after the investment period, management fees are calculated as a percentage of the invested capital that has not been realized yet. So as you sell investments, obviously the number or the amount of management fees that you receive goes down over time. So being able to budget for that is really difficult. So just kind of understanding all those pieces, I think, is important so that you can plan accordingly.
All right. I think that's a great place to wrap up the Q&A. I know there were a couple other questions. We'll see if we can get you direct follow up to those. Um, thank you guys so much for being here. Really appreciate it. This was an awesome conversation.
Thank you, Matt. Appreciate it.
Thanks so much, Matt.
Absolutely. And for everyone else, we're gonna have a pop-up poll. I think it just popped up on everyone's screen where you can let us know if you're interested in learning more about AngelList fund offerings. If you check it, then we'll be sure to have our team reach out. And if you enjoyed this webinar, be sure to register for next Thursday's webinar event, which is titled Strategic PR for VCs with 6 Eastern. We'll include more details on that conversation in the follow-up email, along with a recording of this event here. Once again, Ken and Dolph, thank you so much for joining us. If anyone here is interested in learning more about Orrick and their fund formation practice, you can visit orrick.com or reach out to Dolph and Ken directly. A big thank you to all who tuned in to the conversation today. Thank you for taking some time out of your busy day to do so. And thank you guys once again. It's been great working with you. This was just as good of a webinar as I think we all could have hoped for. So really appreciate it. All right. Have a good day,
Take
everyone.
care. Bye.
Take care.
Bye.